So break down what you think markets are correctly pricing in about the Fed's actions at this point.
I think right now the markets are right that we're likely to see a skip in September, but where I think they might be miscalculating that the Fed is probably going to pick it up at some point later this year. So right now the market's pricing at about a 50% chance that we'll see a rate hike by the end of this year and no rate hike in September. I think we're a little bit more likely to see that rate hike at some point toward the end of this year.
And as you know, Mark, the market knows the Fed isn't cutting rates this year, but still seems to be clinging on to some sort of hope. But what are you going to be looking for as we await the CPI and PPI prints coming out this week?
I think we're going to see CPI probably tick up a little bit. Not surprising with what we've seen with prices recently. Prices would have to be coming down in order for inflation to continue coming down for the rest of this year. And that's just not what we've been observing. So it's not very surprising, but it's made a lot of progress from that peak that we saw last year. So that's always important to kind of keep that in mind. But also important to keep in mind is that the Fed has reiterated that their target's 2%, their target's not 3%, and we're not at 2% yet. We still got a little work to do, and it's going to be a little bit harder for the Fed to get that done, but they don't want to be too aggressive. So they're really navigating kind of a tightrope here where they don't want to be too aggressive, but they need to be aggressive enough in order for inflation not to start ticking up a little bit more meaningfully.
And I want to ask you about some of the equity rally that we've seen. I mean, Ben Emmons of New Edge Wealth said, while all eyes are obviously on Apple's big event, everyone looking for, the newest and greatest with Apple's iPhone, even despite the share price being under pressure since August, he said three-letter words that are more likely to dominate the price action: UAW, IPO, and CPI. Of course, referring to the standoff with the big automakers, the IPO action that we're seeing with Arm and Instacart, and then, of course, CPI data, especially core CPI data that we know that the Fed is going to be honing in on. Do you think that's going to dominate more than what we've seen than with the current equity rally?
I think absolutely. So thinking about specifically with inflation and then other economic data, that has a lot of potential to rattle the markets a little bit more than the market may be pricing in right now. So any kind of upsets to that sweet spot sort of soft landing scenario that the stock market's really betting on has the potential to brings a little bit more downside to the market. And then with activity around strikes, and then even with potential government shutdown, those are other scenarios that have that potential to put a little bit more downside on the market or a little bit more volatility on the market. And I think that that's something kind of key when you're investing to keep those scenarios in mind. There's a pretty good probability that we're going to see some kind of economic shake-up, economic slowdown in the near future that's going to put a little bit of pressure on the stock market.
And I want to ask you about some of the recession outlook, especially when you look at sort of some of the other action that you're seeing global central banks taking. But a lot of people have really pushed out some of these recession concerns, perhaps mid to late 2024, if we end up getting a recession at all. What are you looking at, though, that's making you think that we're going to see a recession, and what type?
So really kind of our thinking around the recession, we're likely to see the worst of it at the start of 2024. So it could potentially start later this year, could start early 2024. And the thinking there really is that, we're a consumer-driven economy and it can keep doing okay as long as the consumer is okay. That key point is how long can the consumer still be okay as prices are still increasing and as the Fed still is increasing interest rates. At some point, we will get to that restrictive territory of interest rates, or interest rates will be high enough for long enough that it starts to impact that consumer. And I think that's really kind of what we're waiting for a more meaningful downturn. Right now, that's been the saving grace with the economy, but I don't know if it can continue to keep the economy afloat for very long.